Welcome, dear students and scholars. We are starting ASC 360, and this first lesson is about the foundation of property, plant, and equipment, or PPE. Before we talk about depreciation, impairment, held for sale classification, or disposal, we need to answer a basic but very important question. What enters the cost of the asset and what stays out? Think of this video as building the fixed asset register correctly from day one. If the opening cost base is wrong, every later calculation can become wrong with confidence. And that is the most dangerous kind of accounting error. PPE is risky because one invoice can affect many financial statement areas at the same time. If a cost is wrongly capitalized, assets may be overstated today, depreciation expense may be distorted for several years, deferred tax calculations may change, debt covenant ratios may be affected, and the audit team will ask for support. Fixed assets are long lived, and unfortunately, fixed asset mistakes also enjoy a long useful life unless someone catches them. So the lesson here is simple. Capitalization is not clerical data entry. It is a judgment supported by evidence. Here is our learning path for this video. First, we identify whether the item is a tangible long-lived asset. Second, we confirm whether ASC 360 applies. Third, we decide which costs are capitalized. Fourth, we connect the topic to related standards such as leases, interest, exchanges, and sales. Fifth, we think about the unit of account, meaning one asset or several components. Finally, we document the conclusion for the close file and the fixed asset register. That sequence is your memory hook. Identify, scope, capitalize, link, unit, document. ASC 360 has one main subtopic, ASC 360-10, but it performs two major jobs. The first job is general PPE accounting, including cost recognition, measurement, depreciation, accumulated depreciation, later expenditure treatment, and derecognition. The second job is impairment and disposal accounting for long lived assets, including held and used assets and assets classified as held for sale. In this video, we are staying mainly in the first job. We are building the cost base before the later videos deal with depreciation, impairment, and disposal. So, what counts as PPE? In simple words, PPE means tangible, long lived property used in the entity's operations. Tangible means it has physical substance like land, buildings, machinery, vehicles, furniture, tools, and equipment. Long lived means it benefits more than one accounting period. Used in operations means the asset supports production, supply, rental, administration, or another operating purpose. If the item is held for sale to customers, it is not PPE. That belongs to inventory under ASC 330. A machine that makes products is PPE. The products sitting for sale are inventory. Scope matters because ASC 360 does not cover every asset that looks important or long term. The impairment and disposal guidance applies broadly to long lived operating assets, including lessee right of use assets and lessor operating lease assets. But goodwill follows ASC 350. Indefinite lived intangible assets have their own model. Financial instruments are outside this model, and deferred tax assets follow ASC 740. This is why good accountants do not jump straight into measurement. First, they ask, am I even in the right standard? The core capitalization test is based on readiness for intended use. A cost is capitalized when it is necessary to bring the asset to the location and condition needed for productive use. Once the asset is ready, later costs are no longer part of initial acquisition cost. They must be analyzed separately as maintenance, improvement, replacement, or expense. The readiness date is the dividing line. Before readiness, we ask whether the cost gets the asset ready. After readiness, we ask whether the cost creates additional future service potential. Initial PPE cost is usually broader than the invoice price. The cost base can include purchase price, non recoverable taxes, import duties, freight, shipping insurance, handling, installation, site preparation, foundations, testing before use, and reconditioning of a used asset before it becomes ready for productive use. The key phrase is directly attributable to bringing the asset to its operating location and condition. If a cost does not help make the asset ready, it should not sneak into PPE just because it appeared on the same vendor invoice. In accounting, invoices can be friendly, but they are not always wise. Land and buildings must be separated carefully because their accounting consequences are different. Land usually has an indefinite life and is not depreciated. Buildings are depreciated over useful lives. Costs such as land purchase price, broker commissions, assumed liens, back taxes, demolition of old structures, excavation, grading, filling, drainage, boundary surveys, and site preparation usually belong in the land cost bucket. Building cost includes contractor charges, architectural and engineering fees, permits, inspections, direct labor, materials, and renovation needed before the building is usable. A common trap is demolition cost. If an old structure is demolished to prepare the land for a new building, the demolition cost is normally treated as land preparation, not as part of the new building. Self constructed assets require more judgment because the company is building the asset internally. Direct materials, direct labor, related payroll benefits, and appropriate construction overhead can enter the asset cost. But the overhead allocation must be reasonable and consistently applied. General administrative costs that do not relate specifically to construction remain period expenses. Abnormal inefficiencies such as wasted materials, idle time, or rework caused by errors should not be capitalized as if they were normal construction cost. PPE cost should reflect a normal, efficient construction process, not a museum of project mistakes. Interest capitalization connects ASC 360 with ASC 835. When a qualifying asset takes a substantial period of time to get ready for its intended use, material interest cost incurred during that preparation period may be capitalized as part of the asset's historical cost. Capitalization begins when the qualifying asset and expenditures are in place, continues during the preparation period, and stops when the asset is ready for use. After that point, interest is generally period expense. The logic is matching. Financing cost during construction attaches to the asset that will benefit future periods. When several assets are acquired together, the first question is whether the acquired set is a business under ASC 805. If it is a business combination, the acquisition accounting model applies, and acquisition related transaction costs are generally expensed as incurred. If it is not a business, the transaction is an asset acquisition. In an asset acquisition, total cost, including transaction costs, is allocated to the assets acquired based on relative fair values. For common control transfers, the receiving entity generally uses the transferor's carrying amounts. So do not assume that every group purchase is a business combination. That first classification question drives the whole accounting treatment. ASC 360 rarely lives alone. Leases connect through ASC 842 because lessee right of use assets and lesser operating lease assets may fall within ASC 360 impairment scope. Residual interests in leased assets are recorded based on consideration given or liabilities assumed. Non monetary exchanges connect to ASC 845, where commercial substance and fair value questions become important. Sales of non financial assets connect to ASC 610. This cross reference map is useful because the wrong standard can give you the wrong answer even when the calculation looks neat. The unit of account asks whether management records a complex asset as one asset or separates it into major components. For example, a complex aircraft might be separated into airframe, engines, interiors, and landing gear if those components have materially different useful lives. A single asset unit is simpler, but it may distort depreciation if the components wear out at different times. Component accounting can create a more faithful expense pattern, but it requires tracking discipline. Whatever approach is selected must be reasonable, consistently applied, and disclosed. A later voluntary change may raise ASC 250 accounting change considerations. Now let us apply the rule to the 2026 capitalization case. The machine purchase price is $500,000, freight is $18,000, installation labor is $32,000, and pre use testing is $10,000. These costs are needed to get the machine to its intended location and condition, so they are capitalized. Operator training is $14,000, but that benefits the employees, not the machine itself, so it is expensed. Total capitalized PPE cost is $560,000. The journal entry is debit property, plant, and equipment for $560,000, debit training expense for $14,000, and credit cash or accounts payable for $574,000. The debits total $574,000 and the credit also totals $574,000. So the entry balances. Good capitalization decisions need a strong close process file. The business team starts with a capital expenditure request, business justification, cost estimate, and project manager sign off. Accounting then gathers purchase orders, vendor invoices, engineering completion evidence, readiness date confirmation, and asset location. The accounting memo applies ASC 360 to each cost item, documents useful life support, and records any tax input. The controller reviews the memo and evidence before approving the entry. Only then should the fixed asset subledger be updated with cost, class, useful life, method, and location code. Let us close the technical part with common exam traps. Training costs are expensed because they prepare people, not the asset. Installation and testing needed for readiness are capitalized because they prepare the asset for intended use. Tax depreciation methods such as MACRS do not automatically become US GAAP depreciation methods. US GAAP needs a systematic and rational allocation over useful life. Finally, when major components have materially different useful lives, ignoring componentization can distort depreciation. These traps are popular because they look easy at first glance and then quietly steal marks from students who answer too quickly. That completes the foundation of ASC 360. Remember the sequence: confirm scope, build historical cost, choose the unit of account, gather evidence, and post only after the capitalization conclusion is properly supported. In the next video, we will take this approved cost base and allocate it through depreciation, depletion, and subsequent expenditure accounting. Thank you for studying with me. If this lesson made the topic clearer, please like the video, subscribe to the channel, support the course, and share it with colleagues who are learning US GAAP in a practical way.